Well, I've been thinking about something lately. I'm sitting here in Seattle, same old office, same old desk, and I keep hearing folks talk about this market crash that's coming 2026. They say maybe sooner, maybe later. And I'll tell you something, I've heard this song before. See, I've lived through, what is it now, 14, 15 market crashes, something like that. Lost count somewhere along the way. But here's the funny thing. Every single time people act like it's the first one in history, they panic. They sell everything. They swear they'll never invest again. And then the market comes back like it always does. And those same people are standing on the sidelines watching everyone else get rich. Now, I'm not here to tell you I know exactly when the next crash is coming. Nobody does. Anyone who tells you they do is either lying or selling something, probably both. But what I can tell you is how to think about it, how to prepare for it, and most importantly, how to use it. Because you see, a market crash isn't a disaster, it's an opportunity. It's the greatest sale you'll ever see in your lifetime. And if you know what you're doing, that's when you get rich. I've been reflecting on this a lot lately, especially with all the hype around AI and tech these days. People are pouring money into it like there's no tomorrow. And it reminds me of the dot-com days. Back then, everyone thought the internet was going to change everything overnight. And sure, it did eventually, but not before a massive bubble burst and wiped out trillions. I see parallels now with AI, tons of investments that might turn out to be dead ends, companies overvalued based on hype rather than real sustainable value. I said we're definitely in an AI bubble, but it's not like tulip mania where everything vanishes. It's more like the dot-com bubble where the crash clears out the weak players and the strong ones emerge even better. So if 2026 brings a crash triggered by AI, overhype, or whatever else, maybe economic slowdowns, inflation spikes, or geopolitical stuff, don't be surprised. It's coming, and it's your chance to position yourself wisely. Let me take you back for a second, back to 2008. The whole world was falling apart. Banks were collapsing, people were losing their homes, the stock market dropped nearly 50%. I remember sitting in my office watching the ticker, and it was bad. The news channels were calling it the end of capitalism. People were comparing it to the Great Depression. But you know what I was doing? I bought into companies that everyone else was running away from, drawing from lessons from past crises. I put billions into stable opportunities that aligned with long-term innovation, even as people thought I was crazy. My phone was ringing off the hook. People I hadn't heard from in years were calling to tell me I'd lost my mind. But I knew something they didn't. Or maybe they knew it too, but forgot it in the panic. I knew that America wasn't going anywhere. I knew that great companies don't just disappear because of a bad year or two. And I knew that when everyone is terrified, that's when you act. There's an old saying, be fearful when others are greedy, and greedy when others are fearful. I made it up because it's true. It's the whole game, really, and I learned it the hard way. Over decades of watching human nature play out in the market, back in 2018, I even said publicly that it's a certainty we'll have another financial crisis. It's just a matter of when. And look where we are now, with markets at all-time highs, AI valuations through the roof, and warning signs everywhere. Through my investment firm Cascade, I've been trimming positions lately, not because I don't believe in tech, but to have cash ready for when things dip. That's part of my strategy. Stay liquid, stay patient, and pounce on quality when prices drop. Now, let me tell you something about how I think about crashes. Most people see a crash as a loss. Their portfolio goes down 30%, 40%, and they feel poor. They feel like they've been robbed. But that's not how I see it. If you're not selling, you haven't lost anything. It's just numbers on a screen. The companies are still there. They're still making products, still serving customers, still earning money, still paying dividends in many cases. What's changed? Just the price. And a lower price is a good thing if you're buying. Think about it like this. Let's say you go to the store and your favorite cereal's on sale, half off. You're going to complain about that? No, you're going to buy more. Stocks are the same way. When the market crashes, it's like the whole store is having a clearance sale. Everything's half off, and yet people run out of the store screaming. That's human psychology. That's fear. And fear makes smart people do dumb things. I've seen it time and again, from the 1987 Black Monday crash to the 2000 dot-com bust, where I watched so many overhyped tech firms crumble. Microsoft survived because we focused on real value software that people needed every day, not just flashy ideas. And now with AI, I'm excited about its potential to solve big problems like healthcare and climate change, but I'm cautious. I've warned that if you're a tech company today, you have to be an AI or risk falling behind. But that doesn't mean every AI startup is a winner. Many will fail spectacularly when the bubble pops, just like in the dot-com era. Now, I'm not saying you should just throw money at anything during a crash. That would be foolish. That's like buying every item in the clearance bin just because it's cheap. Some things are cheap for a reason. You still need to be smart. You still need to know what you're buying. But here's the thing. If you've done your homework before the crash, if you've been watching companies, studying them, understanding their businesses, waiting for the right price, the crash is your moment. It's like being a farmer. You don't plant seeds in the middle of a drought and expect them to grow. You wait, you prepare the soil, you watch the weather, you get everything ready. And when the rain finally comes, that's when you plant. The market's the same way. You prepare during the good times and you act during the bad times. That's the entire strategy in one sentence. Let me tell you about Microsoft. I built Microsoft from the ground up in the 1,970 seconds and 80 seconds, invested everything into it. Biggest commitment I'd made up to that point. And people ask me, why Microsoft? It's just software. What's so special about software? And I'd say it's software that people have been using for decades, and they're going to keep using it for another 100. I can predict that. I can't predict what the next hot tech gadget's going to be. I can't tell you which social media platform will dominate in 10 years. That stuff changes too fast. It's outside my circle of competence sometimes. But Microsoft, I know Microsoft, people loved it in the 1,980 seconds. They loved it in the 1,990 seconds, and they still love it today. That's what I look for. Simple businesses, businesses that aren't going anywhere, businesses that even a fool could run because sooner or later one will. During the 2008 crash, Microsoft stock dropped. Did the company get worse? No. Did people stop using Windows or Office? No. The stock just got cheaper. If I didn't already own it, I would have backed up the truck. You don't need to find the next hot tech stock. You don't need to gamble on some startup that might be the next Amazon. You don't need to understand artificial intelligence or blockchain or whatever the new buzzword is. You just need to find boring, predictable, wonderful businesses and wait for them to go on sale. And let me expand on that AI point because it's relevant today. AI is a huge technical advance, but we're in a bubble. Not a total wipeout, but like .com, where overvalued companies crash and the survivors thrive. I've seen investors chase hype, pouring billions into AI firms that promise the world but deliver little. Through Cascade, we've been selective, focusing on companies with real moats, defensible tech, strong cash flows, and global impact. Even in a crash, I'd look for AI players that solve real problems, not just buzz. A lot of people misunderstand what investing is. They think it's about making quick money, trading in and out, timing the market, watching charts and indicators. But that's not investing, that's gambling. Some people get lucky, but investing is about owning a piece of a business and letting that business work for you for years, for decades. It's about patience, and that's the hardest part, because when the market crashes, patience feels impossible. You watch your account drop every day, your friends are panicking, your family's asking if you're okay, the news is screaming about the end of the world, and every bone in your body is telling you to do something. Sell, get out, cut your losses, anything. But the right move is to do nothing, or better yet, buy more. Let me tell you a little story. In the early days, one of my early investors came to me worried. He said, should we sell? Should we get out? I'm losing sleep over this. And I told him, if you can't handle watching your investment drop 50% without panicking, you shouldn't be in the stock market. That sounds harsh, but it's the truth, because the market will drop 50%, maybe more. It's not a question of if, it's a question of when. And if you're going to sell every time it drops, you'll never make any money. You'll just buy high and sell low over and over again. Now, let me talk about what you should actually do when the crash comes. First thing, don't panic. Even after all these years, there's still a little voice in my head during crashes saying maybe this time is different, but it never is. It always feels different. In 1987, it was program trading. In 2000, it was the dot bubble. In 2008, it was subprime mortgages. Every crash has a different story, but the ending is always the same. The market comes back, so don't panic. The crash is not the time to make big decisions. It's the time to stick to your plan. If you've been investing regularly, keep investing regularly. Don't stop. Don't try to time the bottom. Just keep putting money in. It's called dollar cost averaging. You buy a little bit every month, no matter what the market's doing. When it's high, you buy fewer shares. When it's low, you buy more shares. Over time, it averages out. Second thing, make a list. Before the crash happens, sit down and make a list of companies you'd love to own. Companies you understand, companies you think will still be around in 20, 30 years, write them down, study them. Know what they're worth, figure out what a fair price would be, figure out what a great price would be, then wait. When the crash comes and those companies go on sale, you'll be ready. Third thing, keep some cash on hand. I'm not saying sit on a pile of cash forever waiting for a crash. That's a mistake too. But having some cash, maybe 10, 20% of your portfolio, gives you dry powder. It gives you the ability to act when everyone else is frozen. People ask me all the time, what's the best investment you ever made? And they expect me to say Microsoft or some tech breakthrough. But the truth is, the best investment I ever made was in myself. I spent years reading, learning, studying businesses, reading annual reports, talking to smart people. I didn't have much money back then, but I had time, and I used that time to get better. It's not just about money, it's about knowledge. The more you know, the better decisions you make. And better decisions compound over time, just like money does. Now, let me tell you something that might surprise you. I don't think about money the way most people do. I do it because I love the game. I love finding great businesses. The crash is just part of the game. It's a test. Can you keep your head when everyone else is losing theirs? Can you see opportunity when everyone else sees disaster? That's what separates good investors from great ones. It's not intelligence, it's temperament. I've got two rules. Rule number one, never lose money. Rule number two, never forget rule number one. People laugh, but I'm not joking. If you lose 50% of your money, you need to make 100% just to get back to where you started. That's a hard road. So the key is don't lose it in the first place. And the way you do that is by being patient, disciplined, not using leverage, not betting everything on one idea, not panicking during crashes. So let's talk about 2026. I don't know if the market's going to crash then. Maybe it will, maybe it won't. Maybe it'll crash in 2027 or 2025 or tomorrow. Doesn't matter, because crashes are inevitable. They're part of the deal. If you're going to be in the stock market, you're going to live through crashes. But let's say it does crash. Let's say the market drops 30, 40, 50% over the next year or two. What are you going to do? Panic, sell everything, hide under your bed, or take a deep breath, pull out that list of companies you've been watching and start buying? Because the people who buy during the crash are the ones who get rich on the other side. During every crash, people say this time is different. And it's never different. The details are different, the story's different, but the outcome is the same. The market recovers. Business continues. Why? Because people keep innovating. They keep solving problems. They keep waking up every day trying to make things better. And as long as that's happening, the economy grows. And if the economy grows, the stock market grows. Even if an AI bubble bursts, innovation won't stop. It'll accelerate after the crash, like the internet did after 2000. Now, I want to talk about fear. During a crash, you're going to feel real fear. But investing isn't complicated. It's simple, not easy, but simple. You find a good business, you buy it at a fair price, you hold it for a long time. Everything else is noise. The talking heads on TV, noise. Stock tips, noise. Predictions, noise. Just focus on the business. Is it a good business? Does it make money? Will it still be making money 10 years from now? If the answer is yes, buy it and forget about it. In the late 90s, during the dot-com boom, people kept asking why I wasn't buying more speculative tech stocks. And I'd say, I don't understand them all. They're outside my circle of competence. For a while, it looked like I was missing out. Then the bubble burst. Those stocks dropped 95%. Some went to zero. The lesson is, stay in your circle of competence. Don't chase things you don't understand. It's okay to miss out. Better to miss out than to lose everything. And today with AI, I'm applying the same mindset, excited, but not chasing every hype train. So as we think about 2026 or whenever the next crash comes, remember a few things. First, crashes are normal, they're healthy, they clear out speculators, reset valuations, and create opportunities. Expect them, prepare for them. Second, focus on businesses, not stocks. When you buy a stock, you're buying a piece of a business. Think like a business owner, not a trader. Third, be patient. Wealth compounds slowly, but if you give it time, it compounds into incredible amounts. Most of my wealth was made late after decades. That's compounding. But you have to stay in the game long enough for it to work. Now, I want to leave you with one last thought. Investing isn't about being the smartest person in the room. It's about being reasonable, being patient, and not doing anything stupid. If you can stay calm when everyone else is panicking and buy when everyone else is selling, you're going to do just fine. Not overnight, but over time. So when that crash comes in, 2026 or whenever it comes, remember something, the crash is not the end, it's the beginning. It's your chance to buy wonderful businesses at wonderful prices. Don't waste it. Don't let fear rob you of the opportunity. Read everything you can and then be patient. That's it. Read, learn, and wait for the right opportunity. And when it comes, act. All right. I think that's enough from this old man. Go out there, do your homework, make your list, and when the time comes, be brave. If this resonates, hit like, subscribe, and comment below with your top company for the crash. Let's build that list together.